Welcome, traders, to another Tickmill trading update with me, Patrick Munnelly. Want to update the SP 500 view using the emini futures contract and identify some high probability action areas and price targets for the trading week ahead. Before we jump into the charts, as always, want to take a look at market narratives, market dynamics, and some of the market internals, see what's going on under the hood and where we're at in terms of volatility. So, in terms of the market dynamic and narrative driving markets, obviously the Israel-Iran conflict continues to be a headline risk, and the situation over the weekend deteriorated. There does seem to be some murmurings this morning about looking for some potential off ramps. Certainly, coming some of the wires reporting out of Iran that are looking for ways to basically save face, essentially, and the same with Israel. Really, it's a pretty dire situation at the moment on both sides, and so hopefully there will be a resolution there. Obviously, we have Trump out over the weekend suggesting that deals could be done as usual, but no such deal at this stage. So you want to keep an eye on the headlines with respect to that situation. And we still have the ongoing tariff situation, and the tax bill remains an issue in the background. In terms of the data for the week ahead, today we're going to get a 20-year bond auction, BOJ rate decision overnight. Heading into tomorrow, we will get industrial production, business inventories, GDP Now update tomorrow. Wednesday, Euro CPI, US crude inventories, and the FOMC. Now, FOMC are going to be updating the dot plot, which can certainly be a potential cause for volatility. And then we have the press conference after that, anticipating that the Fed are going to have to remain on the sidelines at the moment, certainly with the potential inflationary risk developing with the spike in oil prices. That's going to be something they'll be keeping a keen eye on. So expect it to be a wait and see scenario from the press conference at this stage. There doesn't immediately appear to be a way that they're going to be reducing rates. And then heading into Thursday, markets are closed for Juneteenth celebrations in the States, but we will get US jobless claims, and we will get Bank of England interest rate decision. And then Friday, we have quarterly options expiration, so potential volatility there. But as noted by our friends over at Goldman Sachs, it's highly likely that given the Juneteenth holiday, that Friday will see a lower participation in terms of volumes, given the fact that the market holiday is on Thursday, and many will likely take the Friday as well to get a long weekend. So that's something to keep in mind. We might see some extra volatility on Friday with that potential for lower participation. As Goldman note there, crowded trades like short oil being noted as particularly crowded, that could see more challenges heading into Friday. So keep those ideas in mind in terms of the range for the in terms of positioning. Before that, we also get VIX expiration on Wednesday. Goldman note that has potentially been supporting the market. The market may again, that idea of the VIX trade on the upside now, as we traded into 22s last week. We're seeing a pullback, currently trading 1969. We'll see where we get the gap in terms of the VIX contract, but in terms of the term structure at the moment with the VIX, we are seeing a reduction in volatility, even though the VIX was up circa 25% last week. The shift down in volatility is expected to continue now, as long as we don't get any material further escalation in terms of the Iran-Israel situation. Certainly, we wouldn't want to see the US getting involved, because that that would see a sharp rise in terms of volatility and the VIX. But as long as we maintain price action below last week's highs, and currently, like I say, below that 20 level, then we're less likely to see any major liquidations going through this week. But like I say, really got to keep an eye on the headlines for any further escalation, which would likely spike the VIX, and then likewise see the potential for a reduction in risk and lower equity markets. In terms of the options pricing at the moment, daily moves between 0.9 and 1.2% are priced in over the next 4 weeks. So notably, the options heading into this week for the FOMC meeting are relatively low. So we're looking at a 0.9% move to the upside or to the downside on FOMC day, while the markets are pricing in a 1.2% move priced in for the July 7th meeting, which suggests that there might be more activity from the Fed seen then, as the uncertainty around the tax bill and the end of the 90-day tariff pause kick in. So we're likely to see a little bit more action on the July 7th meeting, and a relatively tame move expected from the markets at this stage for Wednesday's meeting. In terms of positioning, retail investors continue to trade in around the 5-year average, suggesting they remain engaged, but not as enthusiastic as we've seen them in recent weeks. For single stock retail investors, they've really been in the holding pattern, shifted from net buyers earlier this year to small net sellers recently, obviously with last week's volatility. So I want to keep in mind that in terms of the professional traders, professional investors, significantly reduced demand for leverage equity exposure. And this trend has continued, though the pace of selling note has slowed in recent weeks, making the signal less concerning. Hedge funds have been buying US equities for 6 consecutive weeks, with net leverage now exceeding 50% after reaching a 5-year low in April. So that constituent continues to extend risk and is looking for further upside in the markets. Despite a generally bearish outlook, investors are positioned bullishly due to really limited alternatives. The systematic community, so the commodity trading advisors, trend followers, they remain long the market and is unlikely to sell significantly unless conditions worsen. So again, that idea, unless we start to see the VIX consistently trading above 20 and above last week's high, those cohorts will maintain long exposure. And the key level to watch there, SPX, so the cash market, is 5,800. So any move through there would suggest that they will start to cover long positions and engage the market on the short side. SPX call interest is at an all-time high heading into Friday at 8.7 million contracts. Derivatives trades with Goldman seeing buyers of SPX puts extending to July with a significant premium built in to the VIX curve, and SPX realized volatility at 12, while July VIX is nearly double that. So we're getting contango there in the VIX contracts for the SPX. And that really concludes the under the hood look at the market. So let's jump into the technical picture and see where we are in terms of the technical scenario heading into this week. So I'm using a 6090 to 6100 as the bull bear zone for the week. I'm looking to see any tests into there. If we get bearish reversal patterns, then that would be the first area that I would be looking to engage on the short side. Equally, if we get closes through there, then that's going to signal further upside extension, and I'll give you some targets in a minute for that. Weekly range resistance per the implied volatility from market makers is 61.50 on the upside, 59.14 on the downside. Today's daily range resistance comes in at 60.90, support at 59.72, and these are all September contract price I'm quoting now. So for the June contract, or for the cash equivalent in the US 500, you want to subtract about 52 points to get the equivalent levels. Daily VWAP now is coming in at 1619 and is bullishly orientated. So daily momentum is bullish, weekly momentum bullish also. 5923 is where the volume weighted average price kicks in on the 5-period look back. In terms of market condition, we're currently in a balance situation, although we are breaking that at the moment. Trading 60.71, 60.64 was the balance area high on a five-day look back. 59.65 is the support area there. Weekly one time framing up, still in play. 59.65 is where that would end, and we have our gap levels below us at 58.43 and 57.41 being the nearest gaps to keep in mind. So again, at the current situation is that the markets are orientated still to the long side, even after last week's bout of volatility. So let's jump into these are my current positions and stops. You can see here. Let's jump into the charts and see where we are in terms of near-term trading opportunities. So this is the intraday hourly chart. I posted this chart into the Trading View Tickmill section, highlighting a potential setup or scenario that I'm tracking here. So what we're looking at is a 5-wave sequence of the May 23rd low. So we have our wave 1, wave 2, wave 3, wave 4 was roughly equidistant to the wave 2 pullback, and we also note this wave 1 structure. If we overlay that initial move off the lows, you can see we've got something similar in scope and scale. So I've just overlaid the bar pattern here for reference. I'm not suggesting that it will trade exactly like this, but this is the type of price action I'd be looking for. Certainly any pullbacks now into the projected ascending trend channel support today, coming in around the 60.20 level, I would be watching 60.20 to 60.10 as potential support. Well, obviously the market is trading bullishly overnight, and so the majority of the overnight inventory is on the long side. So we could see a potential snapback early in today's session. So watch 60.20 to 60.10. Bullish reversal patterns there. Certainly want to engage on the long side. And as mentioned, the first area of potential resistance today is going to come in around 60.90, which is our daily projected range resistance. So again, from there, we could see pullbacks, but as the value area high from there around 60.50 then acts as support, again, want to maintain a long exposure. So looking for bullish reversal patterns there. And our next upside objective is going to be a move up into that 61.50 area, which is the daily projected range resistance. Weekly R2 comes in at 61.40. So I'll be cautious there, watching for any bearish reversal patterns or intraday divergences as, again, another opportunity to play it from the short side. What we'll be looking for then is a retest back into this 60-70 area. Note that this contract is adjusted. So with the rollover, we're trading back into the last week's highs. The key support zone to watch is going to be the gap area from the contract rollover. So 59.80 and those 59.70s, which are daily projected range support. And we have that 59.65, the daily balance support. So that's going to be the initial key support area on any significant pullbacks where I would be looking at long positions. But for now, the focus is on the upside, and we're looking for an extension basically to target into the weekly projected range resistance. And certainly as we get into later on Wednesday after the FOMC, we could expect that these quieter markets, certainly, as I say, holiday in the US on Thursday and potentially lighter participation on Friday, could see us drift higher to test into that weekly projected range resistance and the projected ascending trend channel resistance coming in 61.80. Certainly in there again, watching for bearish reversal patterns as an opportunity to play it from the short side. As always, traders, plan the trade the plan, and most importantly, manage your risk. Until next time, thanks very much.